Stock buybacks can create real value. They can also make per-share numbers look much better than the underlying business changed. Those two statements can be true at the same time, which is exactly why buybacks deserve more than the usual good or bad argument. Start with the arithmetic. Earnings per share is profit divided by the weighted average number of shares. If profit stays exactly the same and the share count falls, EPS rises. Nothing illegal happened. No accounting fairy was hired. There are simply fewer slices sharing the same pie. That is why a company can report stronger per-share growth than growth in total net income. AutoZone is a useful case file because its own filings make the denominator visible. In fiscal 2021, AutoZone reported about $2.17 billion of net income and diluted EPS of 95,999 ounces, using roughly 22.8 million diluted weighted average shares. By fiscal 2025, net income was about $2.50 billion, while diluted EPS reached 104,087, and the diluted share count had fallen to about 17.25 million. Total profit grew, but per-share earnings grew much faster because the denominator shrank dramatically. That does not prove AutoZone was faking growth. In fact, its business also expanded. The point is the bridge between company-level economics and shareholder-level math. AutoZone has run a repurchase program since 1998, and by August 2025, it said it had repurchased 155.6 million shares for an aggregate cost of $38.5 billion. In fiscal 2025 alone, the company explicitly said stock repurchases increased diluted EPS by 26 cents. Now comes the question investors should actually care about. What did the company pay for those shares, and what else could it have done with the cash? A buyback below intrinsic value can increase the ownership claim of remaining shareholders. A buyback at an excessive valuation can destroy value even while EPS mechanically improves. If repurchases are funded with too much debt, the company may also trade a smaller share count for a more fragile balance sheet. This is why the SEC's Rule 10b-18 matters to the case without turning buybacks into a conspiracy. The rule provides a voluntary safe harbor from manipulation liability when repurchases meet conditions involving manner, timing, price, and volume. It does not declare every buyback wise. Capital allocation is still a management decision, and wisdom does not come bundled with the legal paperwork. So, who wins? Remaining shareholders can win when a strong business buys undervalued shares with surplus cash. Selling shareholders get liquidity at the transaction price. Management may benefit if compensation is tied to per-share metrics, which is why incentives deserve scrutiny. Who pays? Potentially the remaining owners, if cash is spent badly or leverage becomes excessive. The same EPS boost can therefore signal excellent capital allocation, mediocre optics management, or something in between. The denominator alone cannot tell you which one you are looking at. The calm verdict is not, buybacks are financial engineering. It is more precise. Always separate total business performance from per-share performance. When EPS is sprinting, check whether the company is running faster or whether the denominator is simply getting smaller.